A lot of my friends are stressed out. They're asking me, what the heck is happening with the stock market? In the last 2 years, we've been spoiled and making money with stocks has been easy. Now that the markets are back to normal, meaning volatility is back, we are asking the question, what the F is happening? Really? Let's dive deeper. Hey friends, welcome to Think Finance, and thanks for tuning in. My name is Raj, and this channel is all about personal finance, stocks, crypto, and everything that helps build long-term wealth. 2022 has been noisy so far. If you're invested in stocks, chances are you're losing money for the year. I know I am. And when that happens, like normal human beings, we freak out and try to find answers. So in this video, I will try and connect the dots and discuss how everything that we are hearing or reading ties back to stocks and our portfolios. Ever since the Fed changed their tone and when transitory became persistent, it brought back volatility and uncertainty. The narrative is that the economy is too hot, inflation is out of control, Fed needs to taper and raise interest rate, maybe 3 to 4 times, dump hypergrowth stocks, and focus on value. This shift in tone and economic conditions has led to chaos, uncertainty, and a massive rotation from certain sectors of the stock market into other sectors. How do you make sense as an investor given everything that is going on? To me, you need to understand 3 things: the role of the Fed, the Wall Street playbook, and how it impacts stocks. Our buddies at the Fed have reasons to exist. They manage the currency, economic growth, unemployment, and inflation. When economy is in trouble, you will hear Fed printing new money and lowering interest rates. Not printing money in literal sense, but is issuing credit to banks. Idea is to make a lot of cheap money available for businesses and consumers to invest and spend. It is Fed's solution to spur lending, borrowing, investing, and promoting economic growth. On the flip side, which we are in right now, if the economy is too hot, Fed will start increasing interest rates. High interest rates make borrowing expensive and increases loan costs, slows growth, and keeps prices low. Wall Street has a playbook. Whether we like it or not, many portfolio managers will follow this playbook. You might have heard the phrase, "Don't fight the Fed." To some extent, same applies to this playbook. Don't fight the playbook. It dictates how to position a portfolio given the market conditions. Company news and macroeconomic news like interest rates, inflation, economic growth, and unemployment influence this playbook. We are in an environment where the economy is hot. Inflation is at a 39-year high. Interest rates are expected to tick higher, and 10-year yield is starting to move. A typical portfolio manager will open the playbook and start making moves. Here are some of the strategies. Trim growth, especially unprofitable companies. Most tech companies enjoy a premium share price today based on the potential of future profits. Rising interest rates mean future profits are worth less today. For years, interest rates remained low and that helped tech stocks, but as rates go up, Wall Street is less eager to pay crazy valuations. More on this a bit later in the video. Buy value. In 2022, this is something I've heard every day on CNBC. Again, macro factors. The thinking is rates and yields are rising because investors believe economy is doing good. Businesses and consumers are in much better shape. This means companies and earnings should do fine due to the boom in economic activities. Playbook says be selective. Instead of paying for high valuation and innovative companies, invest in low beta names since they will do good, which will be reflected in higher earnings and higher stock prices. Question is, what is considered value? Banks. It's not complicated why banks rise in a rising interest rate environment. Banks can increase the rates they charge for loans, and that improves their margins. We've already seen banks outperform in 2022. Buy reopening names. Economy is doing good. Recovery is strong. That means names that got destroyed is where the opportunity is. Airlines, restaurants, casinos, and hotels. Other sectors that do well in an inflationary environment are real estate and energy. Indeed, energy did nothing for years and is now one of the best performing sectors for 2022. The point I'm trying to make here is the playbook is defined. Most managers follow this playbook, which is driving what we are seeing in the stock market today. For the most part, I am a dip buyer and a dollar cost averager. But on and off, macro conditions will change, which requires us to relook at how we are positioned. Just because something worked in the past does not mean it will continue to work for the next decade. Let's talk about tech a little bit more, and I promise I'll connect the dots. Why is tech falling? Most tech companies rely on future cash flows, meaning they are probably making a loss today, but are expected to make exponential profits 3 to 5 years from now. This is especially true for hypergrowth stocks, an area where Cathie Wood invests. The higher the rate goes, the lower the present value of these future stream of earnings. As a result, growth stocks that have high expectations for earnings in the future will be hit harder. Call it math, call it economics, time value of money, or discounted cash flow. For example, the value today of $100 that a company is expected to make 10 years from now will be $95 discounted at 0.5%, and $61 discounted at 5%. Higher the rate, lower the value of future earnings. Two super interesting data points. Since 1927, value has outperformed growth for the next 12 months when inflation was over 6%. Today, we are at 7%. Bank of America also has similar research. Value outperformed growth every time when the economy was on a rebound. Most likely because interest rates and inflation were on a rise. This means that when rates go up, trim growth and go all in on value, right? This relationship between rates and growth stocks is not as simple as it sounds. In the last few months, the negative correlation between NASDAQ 100 and 10-year Treasury yield is strong, meaning when yield go up, tech falls. But it's a different story when you zoom out a bit. The correlation is all over the map, moving viciously between positive and negative. There is no noticeable relationship whatsoever. These days, you're hearing a lot of love for value stocks. In a high inflation and rising interest rate environment, valuation is back in vogue. In the short term, we will see hypergrowth stocks get destroyed since they were frothy to start with. Indeed, they are already creamed. And just because they are down 50%, it does not make them a good buy. I would stay away from these until the rate and inflation noise settles down. Quick tip, don't let your emotions mess you up. You'll be better off sticking with traditional quality mega cap tech. These companies have strong balance sheets and earnings to show for. Indeed, I would buy these on any dips and bring down the average cost. In the long term, the correlation between rising rates and growth stocks is all over the place. While they want you to believe that value is going to rule the next decade, no one really knows. And for these reasons, I'm sticking with a balanced portfolio and holding quality profit-making companies, more inclined towards growth. Big tech and semis make bulk of my tech holdings. But if all of this sounds too taxing, just stick with ETF SPY or VOO and ignore everything you hear on CNBC. I think you'll do just fine. That's all for now. Thoughts? Comments? Until later, peace.